Hello, everyone. I'm Kevin Hincks. Welcome to the Daily Trader, a daily look at what's going on in the market and ideas and lessons on potential option trades for this market. These are all done in paper money, so they're example trades, but the lesson here will always be the strategy that you use going forward. So let's get to it. First, let's go over our macro minute. This morning, we had retail sales come out and jobless claims like we do every Thursday. Retail sales were stronger than expected, up 0.4 on the headline. X vehicles up 0.5, and X vehicles and gas, something that leads right into the GDP data, up 0.7. We also had revisions on last month's numbers, both up 0.1 of a point. Then we also had jobless claims come in at 241,000, slightly lower than last month. But the worry is that these numbers, because of the hurricanes, because of the disruptions, may start to be skewed. Those may be already happening, actually. So careful on overinterpretation of the jobless claims data. All right, this morning, we got Taiwan Semiconductor's earnings that are affecting some of the stocks that we're trading today. Our first trade that we'll get into right now, Nvidia. Now, Nvidia is highly correlated to Taiwan Semiconductor, maybe more insulated from like an ASML that took the market down on Tuesday. So we'll certainly watch how this trades, but at least for today, with Taiwan Semiconductor up 13%, let's call it, we'll look at the strength and we'll make a paper money trade in Nvidia, currently up 2.7%. But interesting, it was over 140 pre-market, but has drifted back down as the overall market that was higher to start the day. Now the S&P only up 0.2 as we hit about 10:20 Chicago time, 11:20 Eastern. So let's take a look at how Nvidia is reacting and maybe a paper money trade that we could put on going forward in Nvidia. And what we're going to use in Nvidia is the diagonal spread. What is that? Well, that can be something that you use in place of buying the stock. It's like a covered call, but we use options instead of stock to simulate that. And what does that do? Well, it gives you less risk. You put out less capital, but if a stock pays a dividend, you wouldn't get the dividend. Remember that. So when a diagonal is a pure option strategy that it's in the calendar spread family because you're buying something further out and selling the short-term option, but which uses theta, but it's also embeds a vertical call spread into that diagonal, thus giving you a little more bite when it comes to the delta. I'll show you what that means in a moment. All right, first, let's get to our Nvidia trade. So here's our Nvidia trade, pulling it up right now. So what we did, remember, Nvidia has earnings on November 26th. So we want to stay ahead of that and trade it. So we went out to the November 15th expiration, and we bought the 140 call. Then we went to next week's expiration, October 25th, and sold the 147 calls. So we did a $7 call diagonal in Nvidia, taking advantage of if you think Nvidia may go through 140 and up towards that expected move for next week, which currently sits at about $8. So what we did, we went a little bit inside that, 147 call diagonal. That's trading, well, we put it in, it was about $6.65. Now it's up to about $6.80. Now, your first reaction is, hold on, it's a $7 call diagonal. We're trading $6.80 for it. Yes, that's accurate. But out to November 15th, you've got 29 days till that long option expires, which means you'll have the opportunity, if you can, to extend duration and chip away at that net debit. Each time you roll that option, you extend duration. You can change the strike each time, or what you can do is, if it goes up towards that strike, you could simply close the trade or extend duration on that and chip away at that net debit, which also chips away at your break-even price. So in Nvidia, we looked at a call diagonal buying the No 15th 140, selling the October 25th 147. If you pay 665, that's the risk on this trade. Remember, whenever you do a call diagonal, the risk on the trade is the debit paid. That's the maximum you can lose on this trade. Now, if you look at the on the chart here, on the profit graph, if you look how it peaks around 147 and then starts to drop back down, well, that is when, if it gets there quickly, you might want to defend this trade by moving the option around or rolling the option out to another date or just rolling the option within that date to a higher strike. Now, that might cost you money. The good news is you'll have profits to do that with. Okay, so there's the look at the Nvidia trade, a bullish call diagonal. Now, let's go to our second trade of the day, and that is Apple. Apple, a little bit of a different story, isn't it? Apple touched all-time highs this past week and is sitting only about $5 off of its all-time high, as you know, at $232. They have earnings coming out October 31st. Now, the good news about Apple is their services segment is growing, right? They can all the things that you wear and use, like AirPods and these everything that has a subscription, that part of their business is growing. So they're showing nice growth there. However, they need to show, and the stock has rallied on expectations of a new super cycle coming with the iPhone 16. Will we get that? We'll find out, right? We'll look at data coming from suppliers, and the overall wait times is what you'll be monitoring to see if the orders are coming in, because some of that super cycle was built into Apple, and valuations on Apple, frankly, are quite elevated. If you look at the elevation or the valuation, on Apple, you see that it currently trades at about a 35 implied volatility or price earnings ratio. It also trades about 31 times next year's earnings. So what I mean by that is it's not inexpensive. So the paper money trade that we looked at here in Apple is a very similar, buying the November 8th after the earnings expectations and selling next week's November 25th 225 put calendar. Now, this is a calendar. It has a different looking profit graph. It has a different price structure. It's less expensive than a diagonal because it doesn't have that vertical spread in, but it doesn't have that flat line that's profitable. As you can see, if Apple were to go towards 250 and then way past that to 220 and lower to 210, you might be profitable, and then it might come all the way back down where you, remember, every time you do a calendar spread, you only risk the debit paid. This one, buying the November 8th 225 put, selling the October 25th 225 put, trading about $2.50 debit. Now it's trading about 244. Apple's drifted a little higher, but it's trading right in that range. Now, it's a bearish spread. It's short about 13.5 deltas. You've got about 11.5 vega, which means if you were to get a down move in Apple, and if implied volatility were to tick higher, that would add to the profitability of this trade. You are still collecting just a tad bit amount of theta each day. That'll get more positive as you get into next week, and the theta in that short 225 strike in next week begins to pick up, and the pace of decay seems to pick up. So when that happens, that theta level will get higher. But this is a bearish play that takes advantage of maybe Apple a little bit of softness into their earnings event, or it could be, remember, because you're going to extend duration on this again to November into the earnings week. There's the great thing about this trade is when you're buying post-earnings and then selling pre-earnings, you get to extend duration right into that earnings event, which will be a big debit or big credit that you'll receive, which will really whittle away at that net debit and, of course, the break even. Now, here's the thing. This is a bearish trade in Apple. You had a bullish trade in Nvidia. If you are not bullish in Nvidia, that diagonal, that call diagonal is not the trade for you. If you are not bearish in Apple going into their leading up towards their earnings event, this is not the trade for you. In both cases, what you have at risk is the debit paid on the call diagonal in Nvidia and the put calendar in Apple. All right. That's our show for today, everyone. Thank you for joining us for Daily Trader with Kevin Hincks. Have a great day, everybody.